Hey there YouTube. So in this video I wanted to go over some of the basics about rental real estate income. I'm seeing a lot of really bad advice floating around on the internet about how rental real estate income is somehow not even subject to federal income taxes. That is 100% false. It absolutely is subject to federal income tax. Now there are certain structures you could do about putting property into IRAs or self-directed 401k plans, but we're not going to go down that path. We're just talking about, very simply, you own a rental property in your name, or perhaps you own it through a pass-through entity like a pass-through LLC, and you generate rental income from tenants, you have expenses, and then at the end of the day you've got some sort of net income or loss figure. What do you do with that on your tax return? So the basics, let's just start with what types of income generally kind of fall under the U.S. tax code. The first big one is active income, right? So this is very simply wages that you earn because you're an employee somewhere. If you're self-employed, those earnings are active income. And then if you're, let's say, a partner in a partnership and you actively run that business, you're involved in the partnership. Partners in a partnership that actively participate aren't on the company payroll, right? They receive what's called guaranteed payments, and then any residual income that's allocated to them from the partnership is also subject to federal income tax as well as the self-employment tax. So those are the three big ones for active income. The second category is portfolio income. So this is pure investment income. You see interest, dividends, royalties, capital gains. So if you're trading stocks or bonds and you generate capital gains on those trades, that's the portfolio income bucket, right? And then the last one is the passive income bucket. So passive income is an investment in a business in which you, as the holder of the ownership interest, don't actively participate in the business. So what's an example of what that looks like? So in this one here we have John. He's a 10% owner in a construction business that's an LLC taxed as a partnership, so it's a pass-through entity. He's a 10% owner. He put in capital because a friend of his started the business, and so he wanted to be an investor in it. But he doesn't do anything for the company, right? He's just a limited partner, an owner of the business, a minority owner because he owns only 10%, so it's not like he owns greater than 50% of the company. And it's truly a passive interest to him. The focus is on him. It's not necessarily the company itself. The company is obviously an actively run company, and the other owners that hold ownership interests in it, the income allocated to them might be active, but to John, this is passive income because he does not materially participate in any aspect of the business. He's just an investor, okay? So for rental income falls into that bucket the IRS calls it per se passive activity, right? So if you're generating rental income from a property, whether it's 1, 2, 3, 4, however many properties, under the federal tax rules, that is a per se passive activity. Now, you can overcome that per se classification if you qualify for, so let's say a real estate professional. That's a tough high mark to meet, but some individuals do qualify for that because they do this full time. But for the most part, if you're an investor in a rental property, it's passive to you, right? It's a per se passive activity. And the passive activity classification is important because if you have passive activity losses, you cannot use those losses to offset other types of income, such as active or portfolio. So in this example, let's say that the construction business lost money during the year and John got his Schedule K-1, he was allocated 10% of the loss. Because that's a passive activity to John, he can't take that allocation of loss and offset it against, let's say, his wages or his interest or dividend income because it's a passive activity. And passive activities are subject to the Powell rules, okay? So with the rental property, seen a lot of videos, YouTube, TikTok, you name it, Instagram, where people are claiming that active income is taxable, portfolio income is taxable, but passive income is not taxable. That statement is 100% completely false. Passive income is absolutely taxable to you. It's just a matter of, is it a loss or do you have positive profits? If you have losses, then of course it's not taxable to you because you don't pay tax on net losses under federal tax rules, right? You only pay taxes on net positive earnings, okay? Now, it's also possible if you have multiple investments in various passive activities, you can use losses from one activity to offset passive activity gains in another one. So, and this is where real estate investors really like rental properties, is because the rental real estate losses that they might be allocated from one activity, they can offset against, let's say, another business interest that would otherwise be subject to the PAL rules, okay? So for rental real estate investors specifically, how do they make this claim that they're not paying any taxes? Well, it's because of the losses. It's that simple. It's not that the whole bucket of income is exempt from federal taxes. It's that you're in a loss position. Okay, and so in rental properties, what's unique is that you can very often find yourself in a position where the property itself is net cash flow positive, right? So you have your tenants paying your rental income, you have expenses for management fees, repairs and maintenance, you have the mortgage interest and principal payment, let's say, and at the bottom of that line, when you have the net profit or loss number, you have a cash flow positive business, right? You have net profit for book purposes. But for tax purposes, you compute your net taxable income a little differently. You would take all those items in that column, but then you would add non-cash expenditures for depreciation and amortization. And that's where they generate this net loss for tax purposes. So once you factor in depreciation expense for a rental property, very often that will push your net bottom line into a negative number. And again, I mean, if you have a net negative taxable income position, whether it's for rental real estate, whether it's John up here and he's a passive owner in a construction business that loses money, if you have net losses, you're not paying income tax on the net losses, okay? It's only the positive profits. So the claim that, rental real estate investors don't pay taxes, I mean, again, it's not because the activity itself is exempt. It's because of the circumstances surrounding what kind of deductions you can take will create a net overall loss. And that's what's most important. So I hope that helps clear up some of the different kinds of income and activities and how the passive activity loss rules work against active income. And then more importantly, how does it impact the real estate sector, right? So rental property owners, you're still subject to tax, right, like everybody else on your passive earnings. But again, you're only paying tax if the business itself is making money. If you got a net loss for tax purposes, no taxes due for the most part. So thanks again for watching. Hopefully it was helpful. If you have any questions, please leave a comment below on the video. Happy to answer those. And of course, very much appreciate a like on the video. Subscribe to the channel if you're not already. And I hope to see you again soon. Thank you.